Hello all, and welcome back to the channel. So, you're ready to dive into real estate investing, or maybe you want to add to the portfolio you already have. And you've probably found that the one most crucial decision you'll ever make isn't which property you buy, it's how you pay for it. Getting the financing aspect correct is what drives your entire strategy, profitability, and frankly, your ability to expand. Today, we're breaking down the absolutely best loans for real estate investors. And we're going to move beyond merely interest rates to talk about the philosophies behind these loans. Keep watching, because this is going to save you an enormous amount of time and money. All right, in order to make some sense out of all the options available, you need to understand this one fundamental split in the universe of lending. All investment property finance pretty much comes down to two types. On one side, there's borrower-based financing. This is your traditional path, where the lender is laser-focused on you. They're looking at your personal debt-to-income ratio, your W-2s, your tax returns, your entire life. It's really a question of whether you can afford the payment, largely independent of the property itself. On the other end of the spectrum, there's asset-based financing. Now this is where it gets interesting. In this case, the lender steps away from your personal funds and instead concentrates on the potential of the property to pay for itself. They're asking themselves, is this apartment complex or house going to generate sufficient rental income to cover its own mortgage? Both of these big players fall into this category, which we will discuss: DSCR loans and hard money loans. Grasping this dynamic is your key to choosing the appropriate tool for the job. So why wouldn't everyone just play it simple and stick with the old borrower-based loans? Well, they have a limit, and they get to that limit fast. The biggest hurdle you'll encounter is your own debt-to-income ratio, or DTI. Banks put a hard cap on this, usually in the 43 to 45% zone. If you go over that, you're out. They will no longer lend to you, no matter how great the next deal is. This only becomes more difficult for full-time investors. A clever tax plan is all about showing the least amount of personal income on your returns, which works beautifully to save taxes, but is dreadful to qualify for another conventional loan on your personal income. It's a catch-22. This is exactly why astute investors make the strategic switch to asset-based financing. It separates your personal financial situation from your investment business, allowing you to grow. Now, before we get into the actual loan types, you need a dose of reality on what to expect in general. Lenders view investment houses as riskier than your home, and thus, the rules are stricter. First, expect to pay more. Interest rates are typically 0.5 point to 1 point higher than what you'd get for a residence you live in. That's the risk premium. Second, you'll have more skin in the game. Down payments are significantly higher. Don't play around with that 3% down you get for first-time homebuyers. On an investment property, you're looking at least at 15% to 25% down, and sometimes more. And third, they need to know you can weather a slump, so they'll ask for proof of reserves in cash. That's typically 6 to 12 months worth of mortgage payments in your bank. So, higher rates, bigger down payments, and more in the bank, that's the bottom line. We'll begin with the benchmark, traditional loans. These are the loans that comply with Fannie Mae and Freddie Mac guidelines. They have the lowest long-term cost of capital, which is great for your early rental properties. But that cheap rate comes with some conditions. The underwriting is strict. You'll require a high credit score, typically 680 or better. And that DTI wall we discussed, it's firmly in place here, peaking out at about 45%. But the biggest constraint for scalers is the number of properties cap. You're generally capped at not more than just 10 properties funded. That can seem like a lot now, but if you really want to build up a large portfolio, this cap will be the stopper. So although traditional loans are a great starting point, they're a cage for growth. Perhaps you're a first-time buyer and that 15 to 25% down payment is daunting. Well, there's a fabled backdoor hack you should know about: house hacking. Now, VA and FHA loans aren't technically investment loans. Those are for your primary home. But you can use them for a multi-unit property, such as a duplex, triplex, or fourplex, as long as you live in one of the units. This is a no-brainer. You can put in as little as 3.5% down with an FHA loan. If you qualify, you can put 0 down with a VA loan. You get to live on the cheap, or even for free, by renting out the other units. And you're building your real estate empire with a fraction of the upfront capital. It is, hands down, one of the best ways to get your foot in the door. As you work your way through to more complicated deals, you'll need more complicated tools. Income portfolio and commercial loans. A portfolio loan is a loan that a lender holds on their own books instead of selling off. Because they're playing by their own rules, they can be much more accommodating. Need to finance an outside-the-box property or one that needs a high amount of rehabilitating? A portfolio loan might be your golden ticket, and when you get into properties of 5 or more units, you're dealing with commercial real estate financing. The underwriting for that one is all about the property's cash flow. They use a measurement called the Debt Service Coverage Ratio, or DSCR, and it basically measures if the income of the property can pay its mortgage easily. That's a peek at what we're going to do next. All right, this is where it gets exciting for scaling investors. Here's the non-QM revolution, and the star of the show is the DSCR loan. Non-QM stands for non-qualified mortgage, which basically means it plays by no rules. The DSCR loan is exclusively for investors, and it turns the tables on portfolio growth completely. So how does a DSCR loan work? It's all about one simple equation: the debt service coverage ratio. It's the property's annual net operating income, all of the rent minus expenses, a small amount of vacancy thrown in, divided by the total annual debt service, the amount of your mortgage payment. So, for example, if a property brings in $50,000 a year in net income, and the mortgage is $40,000 a year, your DSCR is 1.25. That equates to the property generating 125% of what it will take to pay for the loan. The magic in this is what's not in the equation: you. There isn't any personal income documentation, no W-2s, and most importantly, no DTI calculation. The loan is approved based on the property's performance, not your check. And that is what makes the key that unlocks unlimited scaling. Your DSCR number not only determines if you're qualified, it actually determines your rate and gives you a tremendous incentive. If you have a DSCR of 1.25 or higher, you're in the highest price tier. The property is well cushioned with cash, so the lender is comfortable and gives you a better rate. A DSCR of 1.0 is break-even. The income barely covers the mortgage. That is riskier, so your rate will be higher. And if your DSCR is below 1.0, i.e., the property actually loses money each month, you can still get a loan, but you'll have to contribute much more money up front, and you'll pay much higher interest rate. This system incentivizes you to be a better investor. You're paid back with improved cash flow on transactions, which itself lowers your cost of capital. Just confirming, though, that just because they don't care about how much money you make doesn't mean it's a free-for-all. Lenders still care about a few things. Your credit score still matters. A 620 might get your foot in the door, but to earn those best rates, you're going to have a score of over 700. And you'll still have to make a good down payment, typically 20 to 25%, so you have a good loan-to-value. And then they'll estimate the income on the property from current rents or a professional market rent estimate. So it's not no rules, just other rules. DSCR loans are also the go-to financing option for short-term rentals like Airbnbs. Since there's no long-term lease, most lenders will say no, but a DSCR lender will say yes based on market statistics and predictions. Just understand that they might charge a slightly higher interest rate because income varies, and you'll want to watch out for prepayment penalties. Since DSCR loans are so long-term, lenders count on that interest. If you pay off the loan early, by selling or refinancing within the first few years, you'll get penalized. So you always have to calculate whether it makes sense to refinance to a lower rate for the penalty cost. Now let's move to high-speed, high-cost capital, hard money loans. When DSCR loans are for long-term holds, hard money is for strategic blitz. That is the money you have fun with to perform a fix and flip or pick up a distressed property in the BRRRR strategy. The entire focus is leverage and speed. You can close 7 to 14 days, which is a huge competitive advantage. Underwriting is essentially all about the property itself, what it's worth today, and more relevantly, what it's going to be worth after repair, or ARV. They're short-term loans with the intent to be paid back in 6 to 24 months. They're a tool for velocity, not for longevity. So what's the payoff for all that velocity? Cost. Hard money is the most expensive capital you'll ever employ. We're talking 10 to 18% interest rates, along with origination fees of 2% to 5% of the loan itself. That is expensive. This isn't a set-it-and-forget-it 30-year mortgage. The only mathematical way this can work is if the speed of financing allows you to buy property at a discounted rate that you otherwise can't buy. You have to make a sufficient gain on the deal to be able to comfortably cover these big costs. A quick but essential distinction: hard money and private money. Hard money comes from business lending companies. Conditions are formulaic, high interest, short duration, and purely dependent on the numbers of the deal. Private money is typically from individuals, maybe family, friends, or a small circle of investors you're associated with. Terms are negotiable and not set. You might have a longer term to pay back or a lower rate, but it does depend on your relationship. And they might be more particular about your individual credit. They both work, but it's extremely essential to know the difference. This is the most important slide about hard money. The biggest risk is not the high interest rate, it's the exit strategy. The loans are short-term and have a balloon payment at the end, where the entire loan comes due. Your plan is to sell the property or refinance on a long-term DSCR or conventional loan. But what can go wrong? Renovations get put off. Permitting is a nightmare. The market will turn on you, lowering your ARV. If you can't complete your exit strategy timely, you will default and forfeit the property. The solution is simple but rigid. You must have a good, pre-vetted exit strategy. That is, you must be pre-approved for your long-term refinance before even closing the hard money loan. Don't skip this step. So let's summarize. Which loan is optimal? It 100% depends on your strategy. If you're a buy and hold investor, start with conventional loans until you're at your DTI limit. Then go to DSCR loans for unlimited growth. If you are a fix and flip investor, your tool of choice is indefensibly the hard money loan. You need that speed and ARV-based underwriting to execute your plan. The premium cost is merely the cost of doing business for a short period. And for the popular known BRRRR strategy, buy, rehab, rent, refinance, repeat, you need to master in the leaping between both. You use hard money to buy and rehab quickly. Then, once it's rented, you do the most important move, the refinance. You refinance the hard money loan with a DSCR loan with a long term, pulling your original capital back out tax-free so you can repeat the process. The entire cycle is dependent on that refinance working. If the property's new value or its DSCR is not adequate, your money is stuck and the whole machine grinds to a halt. Let us put the numbers side by side so you can have a clean view of the trade-offs. For a conventional loan, you can expect 6 to 7.25% rates with minimal fees, but you have scaling constraints. With a DSCR loan, you're paying higher, maybe 7.25 to 9%, with additional fees and prepayment penalties, but you do get to grow. And with hard money, you're in the 10 to 18% zone with very high fees, and your greatest risk is balloon payment and exit strategy. You're really paying for flexibility and speed. So here's the big takeaway. There is no such thing as the best loan. It's a moving target that shifts based on your strategy and stage of your portfolio. For long-term stability at low cost, conventional loans are for you. For high-velocity scaling, DSCR loans are your machine. For transactional velocity, hard money is your knife. But learning to switch between them is the most important skill to acquire as an investor. Knowing how to lever up with expensive tactical capital to purchase a deal, then effectively roll it over into long-term sustainable debt is the magic unlock to continued, profitable, and massive portfolio expansion. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.